Welcome back from spring break. I'm sure you're happy to be back in, what, 22-degree weather outside? Wait, a couple of things. One is I've sent you the case, I think, 5 times in the last 10 days. And I know some of you still, many of you probably haven't even opened it yet. It's due 9 days from today. Okay, so it's actually, so if you haven't opened it, it's time to open it. In fact, if you had a chance to read it, today's session is going to kind of cement some of the things that the case is about. And the other motivation I would give you is the next quiz, which is not that far away. I know, but the last quiz just ended. It's 2 weeks from Wednesday is the next quiz. Will really be about the material you cover on the case. So what I'm trying to say is be involved in every aspect of the case. Don't let one group member who might be much better equipped to take it and run with it, do all the grunt work, and you just sit there and watch. It's better for you to get involved and at least understand what's going on, because this case is actually a multiple test. It's a test of your accounting, because you got to build an accounting statement. It's a test of your finance, obviously. It's a test of your Excel skills as well, partially. Right? You don't have to do macros. You don't have to get carried away. I don't care about colors. So this is not a training the street Excel spreadsheet. Right? That's for investment bankers. So this is a spreadsheet, though, where you have to build with an objective in mind. So read the case, have a spreadsheet open, and my suggestion is start building the spreadsheet as you're reading the case, keeping your mission in mind. You know what the case is about, right? You have no idea? Somebody help me out. What's the case about? Should Apple build an electric car? It's a topic of the moment. Everybody's talking about it. In fact, I considered for a brief period actually offering an alternative, saying, look at the case, and then in the third question I was going to ask you, should they buy Tesla instead? Because that's another way you can enter the business, right? Buy another company. I'll hold off on that, but I will talk about it when we do the case in class on Wednesday, next Wednesday. I'll go through the number crunching on the case and say what would be different if instead of doing this from scratch, which is what the case does, building a business from scratch, you went out and bought an existing business out there, especially if it's publicly traded. It's really not that different. Okay? But because the accounting for acquisitions is a little messy, I don't want to throw that in there. But take it and actually deal with it realistically, because your end game is to tell me whether Apple should enter this business. That's really the end game. Use whatever tools you need to use to get there. So today I want to go back to where I left you 10 days ago. And I know you don't remember where I left you, but if you remember, I was describing this project, the Rio Disney project. I'd given you the projected earnings, and we'd gone through the first phase of the analysis where I projected out the earnings and came up with a return on capital on this theme park across the 10 years, and I gave that caveat. It's only 10 years. I should have probably gone longer, but over the 10 years of about 4%, which was lower than the cost of capital that we computed for this theme park based on the fact that it's a theme park business in Rio. So there's a country risk component and a company risk of 8.5%. So if you looked at this theme park based on the return on capital over the next 10 years, it does not look like a good investment. But remember, it's not based on cash flows, it's not incremental, it's not time weighted, it doesn't meet any of the tests. So you say, why do we waste our time even talking about an accounting return on capital? Here's why. This is perhaps the most widely used metric in corporate finance. What am I talking about? I'm talking about the accounting return on capital. It's a metric that a lot of analysts use to judge companies. We go back to the very first session. Remember I showed you the accounting balance sheet for a company, or actually a financial balance sheet, where I broke down assets into investments already made and growth investments. So each of your companies, you're doing a company, remember, for the final project, each of your companies has investments in place and growth assets, and you're looking at your company. And I think one of the questions that it's always worth asking about a company is, are my existing investments in this company, are this company's existing investments good ones or bad ones. Before you get ambitious about the future, might as well look at what's on the ground and say, is this company doing well? Is it making a sufficient return? And here's where an accounting return on capital can come in useful with all its limitations. What if I could take the operating income that this company has? Let's take Disney as an example. In 2013, their after-tax operating income was $6.92 billion. That's how much they generated as operating income on all their existing investments, which includes all their theme parks, the movies, everything they have. Collectively, they generated $6.92 billion. And the question I'm asking is that enough? I'm not being greedy, but I want to see, given how much they've invested in these businesses, are they making a sufficient return? The question is, how do I know how much they've invested in these businesses? And here's where I'm going to cheat. You probably already know that I don't trust accounting numbers that much, but here I'm actually going, this is the only place in finance where I'm going to trust the accountants while holding my nose. I'm going to go to the book value, the balance sheet of a company, and what is in the book value? If you followed old-fashioned accounting, it's what was invested in these businesses originally, net of depreciation and whatever was put back, right? If I make the assumption, it's a big one, that the book value of what's invested in these businesses is the actual capital tied up in these businesses, I can get a measure at least of whether the company collectively is generating a sufficient return on that capital. So let's take Disney as an example. There's their after-tax operating income. There's the book value of debt. There's the book value of equity. You know what I mean by book value of equity, right? I'm going to do the accounting balance sheet, pulling up the shareholders' equity number. I'm going to take cash out of that because cash can't earn operating income. So what I'm going to compute as my invested capital is book value of debt plus book value of equity minus cash. And if I trust the accountants, it looks like Disney has about $55 billion invested in its existing assets. It's making a $6.92 billion after-tax operating income. If I divide the 6.92 by the 55 billion, I come up with a return on capital of 12.61%. So with the caveat that it's an accounting number with all the problems associated with it, that 12.61% is a rough measure of what Disney is generating on its existing investments. Is that good enough? Well, there's a simple comparison I can make, right? If you remember, I computed a cost of capital for Disney as a company based on the bottom-up approach of 7.81%. So Disney generates 12.61%. It needs to make 7.81%. The difference between those two numbers is called an excess return. It's what you make over and above the cost of capital. If I'm making a big deal about the number, this is why you run a business. It's because you want to generate excess returns. If all you want to do is make your cost of capital, there are far simpler ways you can do it. Just put your money in T-bills, you'll be done. You'll make your cost of capital. It'll be a really low cost of capital. So the reason you start a business, whether you're an entrepreneur or a publicly traded company, is because you want to earn more than your cost of capital. So if I trust these numbers, it looks like Disney is generating more than its cost of capital. I'm going to ask you a question. It's going to sound incredibly stupid, but humor me anyway. What do you think allows Disney to earn more than its cost of capital? You see where I'm coming from? If you're earning an excess return, remember Econ 101? I know you've tried to forget it. It's got to be some barrier to entry, right? Because in Econ 101, if you had a perfectly competitive product market, you know what companies would earn? Exactly their cost of capital. Because if you earn more than your cost of capital, what will happen? Competition will come and drive it up. So when I say Disney earns more than its cost of capital, you know what the next question to me should be? Not how did you come up with the return on capital, because that's a mechanical question, but what is its competitive advantage? What is that barrier to entry that Disney has that allows it to earn more than its cost of capital? And what do you think that is? ESPN, what else? What's an ecosystem? So if I collect a lot of companies, would that automatically give me a competitive advantage?
Well, it's able to apply movies and sell merchandise, characters in the park.
Okay, let's be specific though. Vivendi doesn't earn an excess return. And it has many of the characteristics you talked about. So it's not just any character in the movie, it's one of those characters with big ears. I'm talking about Mickey. And another one which looks like a snowman but essentially plays with your emotions, right? Let's face it, Olaf the snowman is probably worth as much as Mickey right now. You know who Olaf the snowman, you guys are looking, Mr. Who the heck is Olaf the snowman? Where do you guys live? Under a rock? Okay. Frozen, come on, go watch Frozen for a purely corporate finance reason. Your most valuable character is right there. So if you talked about where the excess returns are coming from Disney, it's coming from characters, but those characters are, in a sense, not easily duplicated, right? People try all the time. I remember when my oldest son was 2 years old, because we couldn't get to Disney, we took him to this hotel which had a person dressed up like a mouse. And we told him it was Mickey. He didn't buy it at 2. He said, that's not Mickey. Right? So people try all the time. Of course, you're going to always go to Times Square. You're surrounded by kind of creepy looking Disney characters, right? You don't know whether to run or to hide. Right? But if I asked you where so that's what I want you to start thinking about, because at some point in this class, you're going to be doing this for your company. And you're going to be coming up with a measure of excess return for your company. And then we can talk whether that excess return is, because in this case, Disney clearly generates more than its cost of capital. Vale generates about 2.2% more than its cost of capital. Little bit more than the cost of capital. Where do you think its competitive advantage comes from? Well, it's not quite a monopoly, but it got those iron ore reserves in Brazil. Why? Because it used to be the Brazilian government company. So if it's like Aramco. Where does Aramco get its you know who Aramco is? It's a Saudi Arabian oil company. How do they get all those great reserves? Because it's a Saudi Arabian oil company. So they get first dibs on reserves. So Vale's core advantage came from the fact that they were originally the Brazilian mining company, and they were given these reserves at essentially no cost. And that advantage is shrinking. You know why? Because increasingly the reserves are in Canada or in Africa, and there they don't have the competitive advantage of being the national mining company. Baidu has a return on capital of 17.6%. Excess return. And where do you think that comes from? From the fact that I can't check Google in Shanghai. I can try, but you have a huge market that essentially becomes a protected market. Tata Motors earns above its cost of capital, but I have to tell you, 4 years ago it did not. What's changed in the last 4 years? Who did they buy in 2000? They bought Jaguar Land Rover, and that's turned out to be an incredibly lucrative investment for them. Partly because they got it at a bargain basement price because Ford just wanted to get rid of it. And finally, Bookscape doesn't quite break even. And that's depressing news, right? Because Bookscape is what, that privately owned bookstore. And if you factor in the total beta, they earn less than the cost of capital. And that's bad news for those of us who like independent bookstores. Because it means that this is a business that is going to constantly be on the edge of shutting down. So what I'm trying to say is excess returns are numbers, but those numbers have to have a story behind them. And that basically is why we compute the excess return, is to get a measure of whether your company is earning more than its cost of capital or less, and why. In corporate finance, though, every old wine gets put in new bottles all the time. People claim to have found new ways of looking at things. And usually it's a consulting firm. They create an acronym around it, and they say, this is new, this is amazing, this is magical, try this out. About 20 years ago, a firm in New York called Stern Stewart came to prominence with what they called was a magical new measure in corporate finance. They called it economic value added, or EVA. They say everything's converted in acronym, it's EVA. In fact, to show you how popular it was, by the end of the 1990s, half of the Fortune 500 were using EVAs to measure how well they were doing and to compensate their employees. And a big chunk of those companies were paying Stern Stewart to compute the EVA for them. You're saying this must be some incredibly complicated measure. Here's what the EVA is. Remember that excess return we computed on the previous page? You take that excess return and you multiply it by the book value of capital, you got the EVA. And how much are you paying Stern Stewart to do this for you? I don't know what you're paying, but what part of this equation is magical? Saying, what does this do? What it does is it takes those excess returns we had on the previous page and converts into a dollar value. So if you have positive excess returns, you're going to have a positive dollar value. If you have negative excess returns, you're going to have a negative dollar value. Saying, why? Because let's say I have two companies. One earns 8% more than its cost of capital, and the other earns 5% more than its cost of capital. Which one's the better company? Just go with the numbers. 8%, right? What if I told you the first company has kept itself small, has invested only $1 billion, it's earning 8% more. The second company is a $100 billion company, and it earns 5% more. Well, you say, well, that's a tougher choice, right? Because you can stay small and earn well above the cost of capital, but if you can scale up, I'm willing to accept a lower excess return if you can make it on 100 times more capital. So at its core, I can understand why EVA is trying to do what it's doing. But it's not that difficult for you and I to do this on any company on our own. Just be careful. If you call it EVA, you've got to put that little R next to it with a circle around it and maybe pay them a penalty for doing it. Right? But that's basically a dollar measure of excess returns. And just as you want to earn more than your cost of capital, you'd like that dollar value to be a big positive number rather than a small positive number. And you'd like a positive number more than a negative number. As I said, each of you will be computing an excess return for your company. Whether you want to or not, I'm going to drag you across that line. And some of you are going to find that your companies earn less than the cost of capital. And you're going to possibly freak out. You say, this is horrible. Should I change my company? I'll give you some consolation here. At the start of every year, I compute the return on capital and cost of capital for every publicly traded company in the world. It's a big Excel spreadsheet. If you want, I'll give you access to this spreadsheet. And then I compare the return on capital to cost of capital for all 40,000 plus companies in the world. I have to cut some corners, make some assumptions that are kind of broad assumptions. But it gives me a sense of, across the world, looking at publicly traded companies, does the typical publicly traded company earn more than its cost of capital? What do you think the answer is? Okay. Here's what the numbers look like. I actually initially did all 41,000 and it looked awful, partly because the smallest companies were all losing money. So I said, maybe I'm being unfair. Let me just look at companies that are a market cap greater than 50 million. So I'm not looking at these small basket case companies. So this is all publicly traded companies globally with a market cap greater than 50 million at the start of 2015. So I'm using 2014 numbers to compute my accounting return on capital. Out of the 21,700 companies that had market caps greater than 50 million, 11,722, that's about 54%, earned less than their cost of capital. The median publicly traded company earns less than its cost of capital. And lots of them earn well below the cost of capital. See this blue column? Those are companies that earn a return on capital that's more than 5% below the cost of capital. Let me offer a caveat though. This is based on 2013 earnings. So if you were looking at this, what are some of the critiques you can have? It's 1 year's earnings. Maybe I should be looking at 5 years or 10 years. Maybe they just had a bad year. That's entirely possible. In fact, I did a 10-year average. It looks even worse. And in fact, I looked at the companies that earned well below their cost of capital to see if they just had a bad year. About 2/3 of these companies, which earn more than 5% lower than their cost of capital, have been doing it for a decade or longer. There are lots of companies out there that don't just destroy value, but keep destroying value at an exponential rate. Let's go back to Corporate Finance 101. The very first session I said, survival for the sake of survival makes no sense. Growth for the sake of growth makes no sense. A corporation is a legal entity. If your reason for being is gone, maybe you should stop being. We've been reading the controversy about the GM stock buyback. GM is announced that it's going to buy back $5 billion in stock. I read a Harvard Business Review headline. This is from an editorial that they got two people to come in and write. I don't know where they found these two people. But they said GM stock buyback, bad for America. Really? Bad for America? And their rationale was, if they pay the $5 billion, first they put their survival at risk, to which my response is, so what? We would have collectively as taxpayers probably saved ourselves about $11 billion if that survival had been put at risk 10 years ago and had come through. Survival for the sake of survival makes no sense. But for some reason we get attached to corporations as if they're relatives. And you can see a lot of companies out there which grow and earn money. So the response is, it's making money, but that's a very low threshold. Making money when you have 30 or 40 or $50 billion of capital tied up is not enough. You have to make enough money to cover your required return. Let me ask you a question. What happens to this $5 billion that they use in the buyback? Where does it go? It gets paid out, right? And then what do people do with it? Whatever they want. They could spend it. Is that a bad thing? What do they spend it on? Maybe cars. Oh, that would be novel. It could be Toyotas. It could be Fords. It could be Teslas. It's their money. They're entitled to do it. I will wager that 80% of that $5 billion is not going to be spent. You know where it's going to go? It's going to go back into the market. Where? Wherever investors want to put it. So if they want to take the 4 out of the $5 billion and put it into Facebook and Tesla and Google, so be it. If you let companies reinvest money just because you want them to survive, you know what you have? Europe. That's basically what you have, is you take away the vitality of the economy, and essentially companies will survive, but where will the new companies go for capital if all you want to do is make the existing companies survive? I know it sounds heartless. You're saying, aren't you thinking about the auto worker in Flint? If you're in a bad business, continuing in that bad business is not going to preserve this job. It's going to just delay the inevitable. It's going to happen in 5 years rather than in 2 years. It's going to cost you another $15 billion of government help along the way. In fact, have you ever read a story about GM that doesn't go with the words troubled automaker? That's basically every story. Yesterday I was pulling up 50 stories in GM. Every one of them described GM as a troubled automaker, but I thought the troubles were behind us. I mean, the bailout in 2008 was supposed to remove the troubles. This is the new GM, where they start with a fresh slate, they're back to being troubled. So think about this as a preliminary measure. I'm not saying it's the end game. But if you see a company earning well below its cost of capital year after year after year after year, you got to stop and ask, why do we keep doing this? So, as I said, at some point in time, once you got your cost of capital for your company, compute the return on capital and see if, in fact, this company is earning more than its cost of capital. In fact, I would go deeper. In the case of Disney, if you go to in the book, I actually have computed return on capital for Disney by business. For the movie business, for the theme park. Why is that useful? If you run a multi-business company and you have 15 different businesses or 20 different businesses, you need to know which ones are creating value and which ones are being subsidized, right? If you're GM, if you don't know that, you're going to be in deep trouble. So this is part of the process of running a multi-business company. Might as well do it right. Any questions? Yes?
I just wanted to clarify, one case for the return, we're using the book values everywhere, and for the cost of capital, we're using the market values everywhere. Why don't we keep it consistent?
It's a very good question. This is the only place I said in finance where we use book values. Everywhere else it's market values, right? Cost of capital, debt to equity ratios. Here's why. Let's assume you start a business with $1,000 invested. Let's say you pick a great investment. It's making a 50% return. You're making $50 million a year. Did I say, how much did I say? $1,000. No, it can't be 50 million. Let's say you're making $500 a year. You're making a 50% return. You asked me to come in and estimate a market value for your business. Forget about growth stuff. You're making $500 every year in perpetuity. Let's keep things simple without growth. If I did a market value for your business, I'm going to come up with, let's say your cost of capital is 10%. I'm going to come up with a value of $5,000 for your business, right? Basically, it's going to be earning a 10% cost of capital. So on a market value basis, you will always earn your cost of capital. That's the definition of market value. So if I did a return on capital by marking everything up to market and I do it right, every company will earn its cost of capital. The best companies are the worst companies. And this is exactly the reason why I don't want fair value accounting to ever take off. Because if they do what they say they're going to do, which thank God they will not be able to pull off, every company you look at should be earning its cost of capital, because by definition, that is what market value is. So I want to see what you actually invested. I'm hoping and praying your book value captures that. But everything accountants do to kind of adjust that number puts me off, right? So if you write off your mistakes, big problem for me. Because then you've taken your mistakes off the books. So the return on capital is an accounting number. That makes it easy to use, but it also is its biggest flaw. Right? Any other questions? So let's go back to the project. Yes?
Do we adjust for the capitalization of leases or?
Everything we talked about, we should continue to do, because if you're a retail firm, you should capitalize leases. If you're a technology firm, you have to capitalize R&D, because otherwise you end up with this book value that's meaningless. There are lots of little adjustments you have to make to the book value, but they're pretty routine. You do them for every company. And in fact, my return on capital is a lease-adjusted, R&D adjusted return on capital. I'll still have flaws because I'm still working with accounting numbers, but I'm trying my best to get a measure of what you've actually invested in your projects and what you're earning on those projects. Let's go back to the project. Right? Remember the Rio Disney project. Looked bad on an accounting return basis, but that was based on accounting earnings on this theme park. Revenues minus expenses. I'd like to go from earnings to cash flows. I'm going to do this in 3 steps. Earnings to cash flows to incremental cash flows to time-weighted incremental cash flows. Let's start with the first step. To get from earnings to cash flows, I said you'd have to make 3 adjustments. First is to add back depreciation and amortization. Remember why it's an accounting expense, not a cash expense, so I'm going to add that back. Second, subtract out capital expenditures, because even though the accountant tells me not to worry about it, I still have to pay. And third, subtract out the changes in working capital. What that does is it makes my accrual earnings into cash earnings. So that's what I did. I started with the after-tax operating income I showed you on the previous on 3 pages ago, added back the depreciation and amortization, subtracted out capital expenditures, subtracted out changes in working capital. Increases in working capital reduce my cash flows, decreases increase my cash flows. Now let me take each of those adjustments and let's talk about why we do what we do. To get to operating income, what did I do? I subtracted out depreciation, right? So in the accounting statements, I went from revenues minus expenses minus depreciation to come up with operating income. Now I'm adding it back. That seemed like a useless thing to do. If I'm subtracting it out and then adding it back, doesn't it make it go away? Why didn't I just ignore it in the first place?
Because you get tax deduction.
Because my operating income affects my taxes, so even though I subtracted out and added back, it leaves a residue in my cash flows, right? How much of a residue? That's pretty easy to calculate. If I take my tax rate, which is 36.1%, and I take the depreciation each year, the tax benefits I get from depreciation are just the tax rate times the depreciation. So in the first year, 50 million depreciation, right? 36% tax rate. I save myself $18 million in taxes that year. That's why you need to do this. You can't just say, hey, since I'm going to add it back anyway, why don't I just ignore it in the first place? I've seen people work with EBITDA saying, hey, why are we bothering us? You can't do that because you still have to go through the process of subtracting out the DA because it does affect your taxes and then adding back the DA. And there'll still be a tax times DA in your cash flows, right? Because there is that tax effect. But it does raise some very interesting follow-ups. The benefit of depreciation then is going to be greater as your tax rate gets higher, right? So let's play a game. Let's suppose you guys have 50% tax rates and you have 15% tax rates. You're an airline in Ireland. You're a wealthy investor in Germany. Can you think of a way in which you might be able to kind of combine your two strengths or weaknesses, depending on how you view it, to walk away better? You have to buy aircraft, right? You get depreciation aircraft, but if you bought your own aircraft, the tax benefit you'd get is what? 15% of the depreciation. If they could buy aircraft, they'd get a 50% tax benefit, but they don't need the aircraft. So what's a solution here? What could we do? Well, let them buy the aircraft and lease it to you. And of course, they'll charge you lease expense, but because there's a much higher tax savings, you can maybe get a lower expense. That was the reason the lease business in the US took off. Lease businesses are driven by big differences in tax rates across entities within the same economy. If you make the tax rates for individuals and companies converge, the lease business dies. So the higher your tax rate, the greater your tax benefit. Here's my second follow-up. I actually work with a couple of nonprofits, and I've seen their income statements. They hire the same accountants who do for-profits. So the nonprofit accounting statement looks very much like a for-profit. They have revenues, they have depreciation. And I always put my hand up and say, why are you guys even worrying about depreciation? Who cares? Because if you don't get a tax benefit, I don't care what your depreciation looks like. And if you follow that same principle, there are some non-cash charges that are not tax deductible, right? Like what? You know what impairment of goodwill is? It's when you do an acquisition and you screw up, the accountant 5 years after the fact wakes up and says, oh my God, you screwed up on that AOL acquisition 5 years ago. We've got to take off $15 billion. That's a non-cash charge, but it's not tax deductible. It's one of those useless things we do a little dance about. So, oh my God, that was the biggest charge ever. Then you look at the market price and nobody reacts. If a non-cash charge is not tax deductible, might as well ignore it. It's only the tax deduction that makes depreciation and amortization matter. And that's why we go through the process of subtracting it out first and then adding it back. Any questions on depreciation and amortization? Let me build on that one additional step. Let's assume that you have a business and you're given a choice on depreciation. Much of the US, you're no longer given a choice. It comes from a table that you read off. But let's say you were given a choice. And choices in depreciation broadly can be categorized into straight-line depreciation or accelerated depreciation. Straight-line depreciation, what you do is you take an asset and you write it off in equal annual installments over the life of the asset. So if you have a 10-year life, you write off 1/10 each year. So it's very simple. Accelerated depreciation, there are a number of different approaches. You get more depreciation up front and less later on. You get the same total depreciation, but the timing of the depreciation is different. So I have two separate questions. You're running a business. You're trying to decide whether to go with straight-line depreciation or accelerated depreciation. Which approach will give you higher earnings up front? You know what I mean by up front in the early years? Accelerated depreciation, right? Is that right? Straight line depreciation. Okay, I was just saying, if you agree with everything I say, we're going to be in big trouble. So straight line depreciation gives you higher earnings. Why? Because you're subtracting out less upfront, so your earnings look better. Which one will give you higher cash flows, though? Accelerated depreciation. So there's your choice. Do you want to keep your accountants happy, or do you want to keep me happy, or your investors happy? It's a choice between earnings and cash flows. Is there a way you can get the best of both worlds? What do most US corporations do? They have two sets of books. It's completely legal. They have reporting books and tax books. In the reporting books, guess what they use for depreciation? They use straight line because it makes their earnings look better. In the tax books, they use accelerated because it makes their cash flows look better. They pay less in taxes. It is a huge pain in the neck because from a valuation perspective, when I sit down to value a company, I want the tax depreciation, not the accounting depreciation that I see in the reporting books. And the only clue you can find is it shows up in that deferred taxes line item, so you might be able to back it out. What a pain in the neck. But you can see why companies do it, because they want the best of both worlds. They want to report higher earnings and pay less in taxes. This seems to be one way to do it. So that's a depreciation stop. Everybody comfortable with depreciation and amortization? Let's move on to capital expenditures. There are two reasons why we do capital expenditures. Capital expenditures, of course, are any expenditures designed to generate benefits over many years, right? The first is if you want to create a business or grow a business, you need capital expenditures. So Disney has to build a theme park if it wants to get the cash flows from the theme park. So that's a conventional reason for CapEx, is growth CapEx. But there's another component of CapEx that we tend to forget. It's called maintenance CapEx. You know what maintenance CapEx is? If you run a theme park, rides are going to get old, they're going to start, so you got to replace them. This is not just maintenance costs, it's actually big capital expenditures to keep your investment going. And how much will that maintenance CapEx have to be? Here's a very simple proxy for thinking about maintenance CapEx. I know depreciation is an accounting expense, but there's an original economic rationale for depreciation, which is depreciation captures how much your assets are losing earning value. So if you were thinking about economic depreciation, it's as your assets get older, they're not as efficient as they were originally. So one way to think about maintenance CapEx is if you want to keep your assets as efficient as they were when they started the game, you want to take whatever cash you get from depreciation and put it back into the project. You're saying, why would I want to do that? You might not. If you have a 5-year project, and at the end of the 5 years you're just going to sell off things for scrap, you're saying, why do I care about keeping things looking the way they originally were? You might just let things run. But if you want to keep your project going for the long term, and the longer the term, the more you have to worry about this, the more you want to keep the earnings capacity of your assets going. So your maintenance CapEx needs should be greater the longer the life of your project. You guys have gone into the restrooms in Stern, right? Maybe you avoid them altogether. But 3 years ago, we spent a lot of money making everything mechanized, the paper, the water, huge amount of CapEx. But I'll tell you, Stern has a history of not having maintenance CapEx. So you know exactly what happens over time, right? The paper stops working, the water keeps going even when you leave. You can tell, when you walk into a mall, you can always tell which stores have maintenance CapEx budgeted in and which don't. Because you walk through the mall, you'll see some stores always look new, right? It's almost like they were open at the start of this year. Some stores look their age really quickly. That's because if you don't set aside money for maintenance CapEx, it's not going to magically show up. So when you think about an investment, don't just think about what do I need to get this started. Also think about what do I need to do to keep this going. And the longer you want to keep something going, the more you have to put back into maintenance CapEx. Here again I have a follow-up. When you spend some money, would you rather expense it or capitalize it? If you were given a choice, would you rather expense it or capitalize it? You said expense it, right? But what does it do to your earnings when you expense something? Your earnings go down. Again, it becomes a choice, because when you expense something, it makes your earnings much worse off, but your cash flows might actually be held. And sometimes you might be able to make that choice. Here's an example. Let's assume you run a software business, and that you spend about 100 million. I've said promotional CDs, but that's almost passé. Who sends out promotional CDs anymore, right? Promotional software. You spend out 100 million. So you say, look, this is really a capital expense, and let's say you can mount an argument for making it get it treated as a capital expense. Here's my first question. If you expense 100 million right away, you can see what it does to your earnings. It'll make your earnings lower. It'll make your cash flows higher. Whereas if you capitalize it, it'll make your expenses much lower this year. Your income look much better, but your cash flows will get lower. Here again, companies maintain two sets of books. And remember in AOL, this was the original basis for this example. used to send out CDs in every magazine. You'd shake the magazine and 3 CDs would fall out. And then God help you if you put one of those CDs into your computer, it took over your computer. Okay? So at one point in time, a third of all their expenses were the expenses associated with those CDs. Just like I think at one point in time, half of all Groupon's operating costs were customer acquisition costs. What those were the emails you'd get from Groupon saying, we'll give you $10 off, $20 off, $50 off, just go free, we'll pay you, that kind of stuff, right? And you could technically make the argument that those are capital expenditures, and that's exactly the argument Groupon made, is we want to treat these customer acquisition costs as capital expenditures because this is how we grow, by attracting people into the business. They had a very selfish reason for doing it. They wanted to claim that they were actually making money. Their version of adjusted earnings was to add back all expenses. These are our revenues, are our income. Look, we're making money. We can argue about whether it's really CapEx, but you can see their motivation for doing it. I hope they were not doing that for tax purposes, because then they were truly doing damage to themselves, right? This is at least a little game you're playing between yourself and the investors. But if you go to the tax guy and say, can you tax me on revenues? He said, gladly, I'll take 40% of your revenues right off the top. So I will wager that they maintain 2 sets of books. In the tax books, they were treating this as an expense, but in the reporting books, they want to claim that these are not really expenses. So again, earnings versus cash flows, you can see the distinction. Which brings me to my final adjustment, which is working capital. As I said, when you add back or subtract out the change in working capital, what you're effectively doing is converting accrual earnings into cash earnings. And let me put some flesh on how working capital plays out. Okay? Easiest way to think about this is to think about yourself running a retail store. You own and run a retail store. Talking about the inventory in the storeroom, right? The more inventory you have, the more cash that's tied up. It's the wasting asset. I'm talking about selling stuff on credit and not charging interest. Your revenues might be higher, your earnings might be higher, but you're not going to get the cash flows until you collect. So when we talk about change in working capital, we're essentially saying your revenues can look really good when you sell stuff on credit or you're using inventory, but it doesn't translate into higher cash flows. So when you compute the cash flow, that's why you have to take into account the change in working capital. And the definition we use for working capital in capital budgeting is very narrow. It's not the accounting definition, which is all current assets minus current liabilities. It's the difference between non-cash current assets. Because you can't claim a change in cash as a cash flow, right? That's kind of silly. So it's inventory and accounts receivable, and usually just accounts payable. It's the difference between the non-cash current assets and the non-debt current liabilities. You know what I mean by non-debt? I'm talking about supplier credit, accounts payable, that you treat as working capital. And you have to factor that in, because if you don't factor that in, you're not capturing the cash flow effect. And companies, again, play this game. You'll often see them sell big items just before the close of a quarter on very good credit terms. They'll tell customers, look, we'll give you 200 years to pay. Just buy the stuff. Because what does accrual accounting allow you to do? The minute you sell that stuff, you can claim it as revenues and earnings, but you're not going to get paid for 200 years, so that means you don't get the cash flow. An easy way to catch that again is if you read the income statement and the statement of cash flows next to each other. What you get in the income statement is accrual earnings. What you get in the cash flow statement is cash earnings. And if those two numbers are consistently different, in other words, the accrual earnings are much higher than the cash earnings year after year after year, you have to be very careful, because this company is using working capital as its device to make its earnings look much better. So any questions on going from earnings to cash flows? Add back depreciation and amortization. Why? Because it affects your taxes. Subtract out capital expenditures, both growth and maintenance, because that's how you keep this business going or this project going. And subtract out the change in working capital, because you want to make your accrual earnings into cash earnings. So that gets us from earnings to cash flows. 1/3 of the way towards where we'd like to be. Let's take the second step. To get from cash flows to incremental cash flows, Here's what I'd like to do. I'd like to focus only on those cash flows that are created by this project, not cash flows that would happen anyway. See, what the heck are you talking about? Here's a simple way to figure out whether something is incremental. Ask yourself two questions. What will happen if I take this project? What will happen if I don't take this project? If your answer is the same to both questions, that item is not incremental. In fact, let me remind you of two items I had in my cash flows and earnings that I probably should revisit. The first was, if you remember, I said in the initial investment there was a $500 million expense that Disney has already made that it's not going to get back if it doesn't take this project. So let me start with that. What will happen if you take this project? Well, you've already spent $500 million. What will happen if you don't take the project? Well, you've already spent $500 million. What effect does this project have? Absolutely nothing. So I shouldn't have been counting that $500 million as part of my initial investment, so I'm going to take it out. That, of course, in finance we call a sunk cost. I'm going to revisit this because it's easy in the abstract to think about sunk costs. It's very difficult in practice to ignore sunk costs. There was a second item. Remember that allocated G&A? Where I took Disney's big G&A expenses, including Bob Iger's salary, and allocated a little bit of it to this project. And I told you 2/3 of those expenses were fixed. They had nothing to do with this project. You're saying, why did you allocate them in the first place? Because the accountant told me to. I'm going to revisit that. What will happen if I take this project? Well, 2/3 will get allocated to this project. What will happen if I don't take this project? Well, that same 2/3 is going to get allocated somewhere else. It's not going to go away. There is no incremental effect from this project, so I should never have subtracted it out in the first place. So what I do is I add it back saying, hey, that was a mistake. But when I add it back, remember that allocated expense lowered my taxes. I have to add back the after-tax portion. It's tricky because you're going between pre-tax and after-tax. But I'm trying to make that 2/3 that I allocated go away, saying I should never have subtracted out in the first place. So I'm going to take each of those expenses, the sunk costs and the allocated expenses, because they're both going to show up in lots of projects. Okay? In fact, if you find this too messy, because what I've done is I've gone through the full earnings statement, and then I'm trying to correct myself by adding things back. You can just look at everything on an incremental basis. Start with incremental revenues, incremental expenses. That way you don't have to deal with these adding back of the allocated G&A. You will get exactly the same answer. In fact, I would recommend that you do this at least once just to make sure you're comfortable doing it both ways. In other words, doing the full income statement, then adding back things to get to the incremental, or doing everything on an incremental basis, because they should give you the same answer. So these are my incremental cash flows on this project. Take a look at those numbers. First, notice now, when I did my accounting earnings, there was no expenses in year 0 and 1. Now there are big negative cash flows because I'm building the theme parks in those years. Those cash flows actually continue to be negative till year 3. They turn positive in year 4, and then they start building up over time. So let's start with that sunk cost notion. The argument that something that is sunk should not be factored into analysis is fundamental. I mean, it's easy, intuitively easy to understand why you shouldn't be throwing good money after bad. You shouldn't be making decisions for the future based on bad decisions you made in the past. So we could intellectually debate this. Of course it makes sense. But to show you how difficult it is in practice to ignore sunk costs, I would pick one of you, but it would not be fair. But let's suppose that one of you, just one of you probably, everybody else is happy with their MBA. One of you is having severe regrets about what you did 8 months ago when you came in for your MBA. Severe regrets. You're saying, this is the most useless thing I've ever done. It's not you, it's the next guy, no? But you've already paid tuition for the first year. Looking forward, you say, this is going to make absolutely there is no benefit to me continuing with this. I'm getting no additional value. So everything should be done on an incremental basis, right? But do you think the fact that you've already spent, I won't put a number because it might be too depressing. You spend a lot of money on your first year. Do you think that might affect whether you continue for the second year? That's the question we're asking with sunk costs. Has what you've already spent affected decisions? The answer is, of course, we're human. And there are actually studies that have been done, experimental studies on sunk costs. And one of the most famous is called the Concord study. And what the researchers did was they broke the people in the subjects in the study into two groups. So you're group 1, you're group 2. Okay? And they were given the same facts. This was supposed to be, they were supposed to be executives in an aircraft making company. And they said, we're developing this new supersonic jet for air forces, which cannot be seen on radar. So the first group, they said, we've already spent $9 billion on this plane, but a competitor's come up with a far better plane. We're not even going to be able to compete. We have an extra $1 billion to go. Should we spend the extra $1 billion? The second group was asked the same question, but they just were not told that they've already spent $9 billion. So the two groups were given the same information about the future. It's going to cost us $1 billion more. A competitor's come up with a better product. We're not going to be able to compete. The group that had been given no information about the money that had already been spent did the right thing. They said, this is stupid. Why do we want to throw $1 billion more after $9 billion to produce a product that's not going to be competitive? So they said, don't do it. The first group, though, that had been told you'd already been spent $9 billion, overwhelmingly chose to go along with the investment. That's a scary thought. Because if you've ever worked in a business, you spend a lot of time talking about what you've already spent, right? And then you talk about what should we do now. And you've already poisoned the well because people have made their decisions based on what you've already spent. It's like going into a casino. You've lost $400 by 9 o'clock at night. What's the most sensible thing for you to do? Go back to your room. In fact, leave Atlantic City or Vegas or wherever you are. Leave. Go to some state where you can't gamble. That's an incremental decision, right? Sensible decision. You looked at the probabilities, it doesn't make sense. But what do most of us try to do? Once I get my $400 back, then I will leave. This is how you end up with $7 billion trading losses. Hey, you take a look at these big trades. Nobody says, I want to lose $7 billion. But what happens is you lose $100 million, you try to make it back. Then you try to make it. So each time you do this, you're building up your losses, but you constantly try to get back to steady state. So it's easy in the abstract to talk about sunk costs, but it's much more difficult in practice. And let me add another thing here, which is when we think about sunk costs, it's always easy to make this judgment of don't ignore what you've already spent. But let's assume you're a consumer product company. Test marketing is what you do before you introduce a product, right? Before you even make a decision or project. So by definition, most test marketing costs are sunk costs. Let's say you have a company that has already spent $100 million on test marketing. You can think of any product you want, right? Now, you've spent $100 million, you look at the numbers coming back from the test market, and you looking forward, you think you can make $25 million in incremental cash flows, in surplus value going forward. Remember, you're not allowed to treat sunk costs. So if I asked you, should you take this investment, the answer is, hey, yes. But if you think about collectively what you lost on this project, you've lost $75 million. If on every project this happens, you spend $100 million first, and then you make $25 million, you're not going to be in business too long, right? So the question is, how do you stop yourself from spending the $100 million in the first place? This is the quandary that every pharmaceutical company has faced for the last 35 years, right? Because you do the R&D expense first, and then you say, should we develop the product? And by the time you've spent that money, it becomes a sunk cost. It's okay if you're in such a good business that you can take the bad projects and cover them with your good projects. If your business is really good, as it was 20 years ago for pharmaceutical companies, you could afford to write a blank check to R&D saying, hey, spend what you want, we'll make it up on our good projects. But that's no longer the case. In other words, if you want to stop spending so much on sunk costs, you almost need two stages for your investment process, right? The first is before you spend on test marketing or R&D, you've got to stop and ask, should we do it? You're saying, that's going to be really difficult to do. I agree. You're asking, should we be spending $3 billion on research in this area? But unless you do this, it's going to be too late by the time you've spent the money to come back and say, I wish we hadn't done that in the first place. We'll talk about some techniques that might be available for us to use, both from probability and real options that you can use to make this judgment. But you almost have to do this in 2 stages if you want to do it right. One before you spend the money, and one after you spend the money. Of course, it becomes a sunk cost. You can go back to that first principle. If it's already spent, I shouldn't be counting it in. Let's talk about allocated costs. As I said, this G&A thing is not unique to Disney. It's probably in every large company there is this cost that's going to get allocated to projects. And much of that cost is going to be fixed. It has nothing to do with the project. And often it's difficult when you look at a project and ask how much of this cost is fixed and how much is variable, because you see $100 million allocated to your project. Some of it is variable, some of it is fixed, but it's difficult to make that judgment. So I'm going to give you a very simplistic example to kind of illustrate one way in which you might be able to determine how much of that allocated G&A cost is fixed and how much is variable. So let's assume you're looking at a company. This is the whole company. And you have the total G&A cost of this company. So the question you're trying to address is, how much of the G&A costs in my company are fixed and how much are variable? So here's what you have. You have revenues in year 1, year 2, year 3. So let's say these are 3 years of revenues, and G&A costs in years 1, 2, and 3. I told you it's a very simplistic example, but with the 3 years of data, can you tell me how much of the costs, the G&A costs in this company are fixed and how much are variable? What's the definition of a variable cost? As revenues change, the cost changes, right? When my revenues go from 1 to 1.2 billion, my expenses went from 250 to 270 million. So $200 million increase in revenues translates into a $20 million increase in G&A. Then when they went from 1.2 to 1.5 billion, the 300 million. So it looks like every 100 million in additional revenues increases my G&A by 10 million. So use that to kind of figure out how much is fixed and what would you do? 40%. And how did you come up with the 40%?
You take the 1 billion revenue, divide by 10, so that's 100 out of 250.
Okay. In fact, what's the essence of a fixed cost? If my revenues go to 0, the costs still are there, right? So if you wanted a very simple way to think about G&A costs, ask yourself, what would happen if my revenues went from $1 billion to 0? It's an extreme example, as I said, but since for every 100 million in additional revenues, I have 10 million G&A. If I take the billion and make it 0, my G&A cost will drop by 100 million, which effectively mean that even if my revenues are 0, my G&A cost is going to be 150 million. That 150 million is going to be fixed. The rest is my variable cost. I know it's very simplistic. You're never going to get a company where everything moves in this nice step. But if I gave you 25 years of revenues in G&A for a company, and you had a basic statistics package, basically you could run what are you looking for? You're looking for how do my G&A costs change as my revenues change. You could start to make some judgments about how much of your G&A cost is fixed and how much is variable. I'll leave you with one final anecdote on this issue of incremental. I said the key is to ask 2 questions. So 150 million, if you want to write the answer, 150 million is fixed because if you make your revenues go to 0, that's what your G&A cost would continue to be. The rest is variable, right? So now let me close off by giving a kind of anecdote to bring this home. I said 2 questions to ask. What will happen if I take this project? What will happen if I don't take this project? About 10 years ago, I was doing a training program for an investment bank's analyst group. And usually I used to do them almost continuously from the middle of June to the end of July. Every single day it'd be a different bank. I wouldn't even know where I was by the end of the process. Like 36 days in a row. And by the time I got to the end of July, I was just on autopilot. I could do the session without even thinking about it, and I usually did. So this was uptown. It was in a hotel. There was like 400 people in the room. These were like the good old days for investment banks. And there was catering. That's how good things were. The guys outside would set up food for them every 2 hours so they could load up so they could go the next 2 hours. So it was the end of July. I was wiped out. It was the 3rd day of the session, of a 3-day session. And everybody in the audience was wiped out. But there was a guy setting up the catering outside who was the most interested person in the whole room. He stood at the door and he listened to every word I said. I wasn't listening to every word I said, but he was listening to every word I said. So the end of the second day, he comes to me and he says, I've been listening to you and I have a question. I said, finally, somebody has a question. So what's the question? He said, I'm from Guatemala. And every year, I fly back home. And when I fly back home, I go to the Gap and the Limit and I buy seconds. Seconds are clothes with defects in them. And I spent about $600 buying these seconds. And I go back to Guatemala. I sell them for $1,000. But it costs me about $1,000 round trip to go to Guatemala. And all my accounting friends tell me I should stop doing this. I said, stop doing what? He said, stop buying these clothes because I'm making a net loss. You see how the accounting mind works? Which is you're making $400 on the clothes, but it costs you $1,000 round trip. That's a loss of $600. You should stop doing this. So I had to ask him the question. What's the question you need to ask him before you tell him to stop? Are you going to fly back to Guatemala anyway? He said, of course, my entire family is there. Which makes $1,000 what? It's not quite a sunk cost. It's a non-incremental cost. It's not sunk because you haven't already spent it, but it's a cost you're going to spend anyway. In fact, if he listened to his accounting friends, what would happen next year? He'd spend $1,000 round trip, but instead of reducing that cost by $400 like he was for the past 5 years, he's now going to spend it. This is why you shouldn't listen to your accountants. Because you know how many companies shut down divisions because they're losing money? That's a money-losing division. Let's shut it down. I remember an investment bank, I won't name the bank because it would be embarrassing for the bank, in the late 90s that shut down its Asian equities division because it was losing money. Now we can go back and I said that was incredibly stupid. But it was incredibly stupid even at the time that they did it, and here's why. If you looked at that Asian division and looked at why they were losing money, 90% of the expenses were allocated expenses. Like what? Like if you were an investment bank, you went for Chinese food, you said that's Asian food, let's charge it to Asian equities. Things like that. You know, basically everything got charged. So you were allocating stuff to Asian equities which had nothing to do with Asian equities. So you shut it down, what happens the next day? These guys still go to Chinese food and they charge it to what? Structured products, unstructured products, whatever it is, right? These expenses don't go away. So the next time you see somebody saying, this is a money-losing division, we're going to sell it or we're going to shut it down, take a look at whether it's really money-losing or whether it's a division that has an accounting loss but actually is generating cash flows for the company. Which brings me to the third leg of it. We've gone from earnings to cash flows to incremental cash flows. Let's make them time-weighted. Sounds fancy, right? When I took finance, which was a long, long time ago, the last 15 or 20 pages of my corporate finance book used to be time value tables. Present value tables. Have you ever seen one of these? Like ancient history. But what it would give you is how much a dollar was worth in 1 year, 2 years, 3 years. It'll have discount rates at the top and the value of a dollar in time. So you could see a dollar in 1 year is worth 90 cents. A dollar in 2 years is worth 82 cents. That's time weighting. Every time you do discounting, you are time weighting your cash flows. And the further out into the future and the more uncertain your cash flow, the more you will time weight the cash flow. So discounting and compounding are really time weighting cash flows. So when we talk about time weighting cash flows, we're just talking about discounting these cash flows. I'm a little old-fashioned when it comes to discounting. I don't trust that PV button on my calculator still. I don't even have a calculator, so I can't trust it. But I don't even use the PV button in Excel because I really don't trust it. So I still use equations to do present values. You don't have to. But this is the only page you need. This has every equation in present value that you will ever use in finance. There are only 5 types of cash flows you can ever run into in finance. Might as well deal with them all. The first is a single cash flow in the future. $10 million 10 years from now. Present value, take the 10 million. You discount it back at 1 plus the discount rate, raise the power 10, you're done. You could have an annuity. What's the definition of an annuity? Same cash flow, constant time intervals, right? So $27.5 million every year for 10 years is an annuity. It's a big annuity. It's an annuity. The present value of an annuity is the annuity, and that's the present value equation. That's what you get when you get payment N and R on your calculator. You can test it out if you want. Okay? A growing annuity is not actually in your calculator, but you can program it in if you have a programmable calculator. And here's what a growing annuity is. Let's suppose you own a gold mine, a real gold mine, not a fake one. Your cash flows are $1 million and they're expected to grow 3% a year for the next 25 years, at the end of which you run out of gold. And ask you, what's the present value of this gold mine? You can do it the long way, which is take each cash flow discounted back to today. Or you can use this growing annuity formula. And again, if you don't trust me, try it out. You will get exactly the same value. It is a very useful equation to have if you have to value a business where you're going to have 10% growth for the next 10 years and you're in a hurry. You can't do 10 years of cash flows. And then you get to those two cash flows that scare the daylights out of people, and they should. The first is a perpetuity, which is an annuity that lasts forever. The present value of a perpetuity is the cash flow divided by the discount rate. And if you're intimidated by perpetuities, a growing perpetuity is even more scary, right? That's a cash flow growing at a constant rate forever. And the present value of a growing perpetuity is the expected cash flow next year. It's always next year's cash flow divided by the difference between R, which is your discount rate, and G, which is your growth rate. It is the most dangerous and most misused equation in corporate finance and valuation. So one of the things I'll do as we go through this class is put some limits on how you can use that equation. But it's actually very useful for tying up loose ends. So when we talk about time-weighting cash flows, we're just saying move the cash flows back to today. And when you time-weight cash flows, there are two ways in which you can look at your project and come up with a time-weighted incremental cash flow return. The first is to take the present value of every cash flow, add them all up, and come up with a net present value for your project. So if you have 25 years of cash flows, discount them all back, come up with the net present value. And it's a very simple decision rule. If your net present value is greater than 0, it's a good project. If it's less than 0, it's a bad project. And it's actually intuitively one of the toughest things to grasp. Because how much is Disney investing in this theme park? Roughly $5 billion, right? And I'm saying if your net present value is $1, it's still good. Part of you is screaming, no, I'm investing $5 billion. How do you explain to somebody that even $1 is okay? We'd much rather have it be $1 billion, but why is just even $1 net present value still okay? Even if you're investing $5 billion? It's over and above your cost of capital. It's surplus value. Would you rather that it be $1 billion? Sure. But $1 is better than 0, because if you don't take the project, your net present value is 0. So it's a very simple decision rule. But people have trouble with it because it's a dollar value. What I mean by that is if I ask you, what did you make last year in your portfolio? Assuming you had a portfolio. The answer you usually get is a percentage number, right? 18%, 22%. We tend to think in percentage terms. So the second time-weighted cash flow measure is called an internal rate of return. The internal rate of return is that discount rate that makes your net present value 0. So if you, through trial and error, you arrive at that rate, that discount rate that makes your net present value 0. You're saying, how am I going to use that? Compare it to your hurdle rate, your cost of equity, your cost of capital. If your IRR is greater than that hurdle rate, you have a good project. These are both time-weighted incremental cash flow measures. Next session we'll talk about why the two might give you different answers sometimes, but most of the time they will deliver the same result. If one says good project, the other will say good project as well. And that's effectively how we're going to put closure on this project. Remember, it didn't look good on an accounting return basis. I'm going to try to compute the net present value for this Rio Disney theme park. But before I do that, I want to tie up one loose end, which was I stopped after year 10 when I did my accounting returns, right? And I waved my hands and said, I wish I could go longer, but I'm bored or I'm too nervous, I can't do this. While I cannot deal with what happens after year 10 on an accounting return basis, I can do something in my cash flows. And here's what I'm going to assume. I'm going to assume that this project continues after year 10. For how long? Initially forever. I know part of you saying, no theme park lasts forever. You're right. But I'm going to do it forever. And I'm going to assume that the cash flows grow at the inflation rate in perpetuity. See why I made it just the inflation rate? If I allow for a growth rate higher than the inflation rate, What am I effectively assuming? That more people will be coming to the theme park year after year after year, right? And what's the problem with that if I make that assumption forever? At some point in time, people are going to come in and they're all going to be just crowded and there's no place to go, right? Which means if I make an assumption which is different from that, I then have to assume more reinvestment, more. So I don't want to do that. So I'm going to keep the growth rate at the inflation rate. So what I'm effectively assuming is Disney is going to be able to raise ticket prices at the inflation rate beyond year 10. So if your cash flows are going to grow at that 2% rate, which is the inflation rate in perpetuity, that's a growing perpetuity, right? The present value of a growing perpetuity is the cash flow 1 year out. So I stopped in year 10, so I get the cash flow in year 11, because that's 1 year out. That's what the numerator is. Divided by the difference between my cost of capital, 8.46%, and the 2%, which gives me a number, a big number, 11,275 million. By far, it's the biggest number. And if you look at the cash flows, there are my cash flows for the next 10 years. There's the giant in year 10. In fact, I presented this to a group of managers at Disney. And of course, they all latched on to the 11,275 because it's driving the entire process. They asked me, what is that number? So I'm going to throw that question back on you. I want an intuitive peg on which I can hang this number. If somebody asks you, what does that mean, that 11,275? How would you explain that number? What is it? Yes?
It's what you would get if you sell the business to someone else.
Okay, let me complete that process. It's what you would get if you sold the business to somebody else, lock, stock, barrel, and Mickey included, right? You see why? Because I have to be willing to sell the business with the characters, because if I pull the character, this is not what somebody's paying for the physical assets. It's for an ongoing theme park with everything in it, which means that Disney will never do this. So it's almost a hypothetical, because there's no way Disney will sell a theme park with Mickey and Minnie and Goofy and Pluto wandering around. Yeah.
But you can sell the cash flows, right? Basically.
See, but the cash flows come from what? From Mickey. You can't, see, everything is tied together here. Because if you think about cash flows, the cash flows come from the fact that people come to the theme park. Why do they come to the theme park? Not because they want to go on the Dumbo ride, but because they want to see Mickey. Right? So in a sense, it is, that's what I meant about lock, stock, barrel, everything else included. But if I throw that in, you know what I've just done, right? I've brought in what happens after year 10. And then another person in that group said, but theme parks don't last forever. And he's right. So I asked him, how long do you think a typical theme park lasts? He said, about 50, 60 years. Let me ask you a question. If I made this, instead of a perpetuity, into a 50-year growing annuity, remember that growing annuity formula I said 2%? You know what the present value I'd have got would have been? 11.1 billion. I'm very close. When people use perpetuity formulas, one of the nitpicking ways to jump on them, it's say nothing lasts forever. You're right, nothing lasts forever, but do some things last a long time? If your answer is yes, forever does a pretty good job of getting close to a long time. It is an assumption of convenience we make in valuation and corporate finance. It's not because we're some optimistic people who think the world's going to last forever and companies go on forever. But if you have a long enough life, a perpetuity is going to get you there much more quickly than doing the mechanics. But if it really bothers you at a philosophical level to assume forever, use a 50-year growing annuity. You will get an answer very close to mine. And maybe you feel much more comfortable with that number. But the net present value that I get for this theme park is 3.3 billion. Remember, your job was to be the decision makers, right? I was the number cruncher. When I showed you the accounting return on capital, it didn't look good, but now I'm showing you the net present value. And based on the net present value, what's your decision? Good project, bad project? Yeah, it looks like a pretty good project, right? In fact, I'll go further. If you take this project as Disney, your value as a company will increase by roughly $3.3 billion. That's the great thing about net present values. They're additive. So if you take a project with a net present value of 3.3 billion, your value increases by 3.3 billion. If you take a project with a net present value of $1 billion, it increases by $1 billion. If you take a project with a net present value of 0, nothing happens. If you take a project with a net present value of minus 5 billion, you say, who would be stupid enough to do that? Let's say you were. your value will decrease by 5 billion. And guess what? Every year there are at least 100 transactions where your net present value is minus 1 billion, minus 3 billion, minus, what am I talking about? What kind of investment do you have to make to have that big of a negative net present value? It has to be an acquisition. It's got to be a big investment. When you make a really bad acquisition, guess what? You've taken a huge negative net present value project. That's the way to think about it. You say, but it's not a project, it's an acquisition. An acquisition is a gigantic project. If you overpay on an acquisition, it's exactly the same thing as taking a big negative net present value project. So that's the NPV, and you can see the NPV turned positive even though the accounting returns over. What do you think tilted the scale? Where did I go from a negative conclusion on my accounting return on capital to a positive one? Was it the discounting? No, the discounting actually hurt me, but it's the fact that I brought in what happens after year 10 that tilted the scale. So be very clear about why the answer changed. It's because I brought in what I think is a more realistic assumption about when a long-term project delivers its cash flows. Any questions on NPV? Then I decided to complete the process by saying, let's see what the other time-weighted approach computes. I know the way we compute IRR is we hit the IRR button on our calculators and on Excel, and it computes an IRR. I actually prefer what's called an NPV profile. It sounds fancy, but here's what I did. I took my cash flows, and I tried different discount rates. So 1%, 2%, 3%, all the way up to 30%. And I plotted the NPVs. What was my definition of IRR? It's where my net present value is 0. So I look to see where it crosses the axis. My internal rate of return for this project is 12.6%. You'd have got roughly the same answer with Excel, but I'll tell you why I prefer this. When you take a project, you estimate the cost of capital, right? Keyword is estimate. You're never certain about it. You say, what if I was wrong? The cost of capital could be wrong. It could be higher, it could be lower. It could shift because interest rates change. Wouldn't it be nice to know how sensitive your answer is to changes in your cost of capital? When you did fixed income, did you do the duration measure? What does duration measure again? In a bond? How the price changes as interest rates change, right? And it's a big factor in bonds. The steeper that line, the more sensitive your bond price is to changes in interest rates. See this line? If I take the slope of this line, the net present value line, you know what I'm getting? I'm getting a measure of how sensitive this project is to changes in my cost of capital. It doesn't change my decision here, but what if you had two big projects you could take as Disney? You could invest in the Rio theme park, or you could expand ESPN, and you could spend roughly the same amount. And I drew the net present value profiles for both. They're both positive, but one was less sensitive to changes in the cost of capital than the other. That might be a factor in your decision making, right? You'd rather take a project that's less sensitive to cost of capital changes than more, especially in today's world where people worry about the Fed and interest rates changing. This might become an input into your decision process, and the only way to get the information for that is to draw the entire NPV profile. So if you believe the IRR is actually telling you exactly the same thing the net present value was, which is if you take this project, you will add value. It's higher than the cost of capital. And as I said, we will talk about when the two approaches might give you different answers, because they will sometimes give you different answers. And we'll come back and talk about them. But don't make too much of those differences. If you have a standalone project and your net present value is positive, almost always the IRR is going to deliver the same message. I know we're at the end, but I'm going to leave you with one final thought. When I put out the original numbers for this project, I said I was going to cheat and give you all the numbers in US dollars, right? And I said it's cheating because all the numbers would really be in nominal reais. So I have a kind of a generic question. If I'd done the entire analysis in nominal reais instead of US dollars, do you think I'd have ended up with a different decision for this project? Let's go through piece by piece. Let's start with the discount rate. My discount rate in US dollar terms was 8.46%, right? If I'd done everything in nominal reais, what will happen to my discount rate? Would it be higher or lower? Higher. Why? Not risk, because the risk I brought into my cost of capital as well, but because of inflation difference. So I'll have a higher discount rate. In fact, it turns out that my discount rate will be about 15.91%. You say, I told you so. It's terrible to do it in nominal reais. But my discount rate is higher because I have higher inflation, right? Let me turn to my cash flows. I did all my cash flows in US dollars using a 2% inflation rate. If I did everything in nominal reais, guess what? My cash flows are also going to be different. And in fact, while my discount rate increases, remember that expected inflation trick that we use to convert discount rates? If I did that for my cash flows, here's where it shows up. My forward exchange rate, that's what I've got to convert it, will reflect a difference in inflation. My cash flows are going to be higher because of higher inflation. And here's the magic of being consistent. I have a higher discount rate, I have a higher cash flows. My net present value nominal reais is 7.74 billion, which if I convert back at today's exchange rate gives me a net present value exactly equal to the nth decimal point as what I'd have got if I'd done everything in US dollars. And that is incredibly good news. You know why? Because when I give you a project, what am I telling you? Pick a currency, do it right. Because if you pick a currency and you're consistent with that currency, you should get exactly the same value if you switch currencies, because everything is already incorporated in whatever currency you've chosen to do the analysis in. So if you get a chance, look at this table. We'll start with this table next session. So if you have any questions, might as well get them out of the way before we move on. Mexican or yeah?
But 70% of the costs come from commodities. It's poultry and meat company in Mexico. I have to consider a different data, or how would it, because I mean the revenues come in pesos, but the costs are in.
That's an effective beta.
Not at all. And like in terms of risk profile.
Well, there's a mismatch in currencies that can potentially increase default risk. It can show it as a higher cost of debt, or you can build in expected for costs from hedging. You can build a hedging cost. Oh, it's very easy. Basically, you have to convert either the dollar cash flows into pesos or the peso cash flows into dollars. It's probably easy to do the dollar into pesos. Okay? So you'd have to buy forward contracts to convert everything in. So essentially, you'd use today's exchange rate to get started and use either the forward market or what we did with purchasing power parity to get expected exchange rates, convert them all into pesos. Okay? There are corporate finance implications, which is if you borrow money, you can borrow money to try to make this problem go away. You should borrow in dollars rather than pesos, but that's kind of a side story. But it's not going to show up in your beta. But you have to have a currency choice. You have to decide up front whether you're going to do everything in pesos or dollars. If you let them both continue in your analysis, it's going to completely throw everything off.
No, it's like the company's a big company, but it doesn't hedge against currency.
It's fine. That basically then the question you got to address is it will make it riskier to you as an investor, but that doesn't mean your discount rate has to be higher, because if your investor is Blackstone, the reality is you're in so many different companies that a big chunk of that risk is good. So in fact, I think they're doing the right thing not hedging, because
they don't have any institutional investors that are.
then you can raise the issue of, because your investors are primarily domestic Mexican investors, by not hedging you're increasing the risk, and you have to factor in a currency risk premium in addition to a country risk premium, because it's a separate issue from the country risk, right?
Okay. I'm going to send it to you this week. If that's
Okay, sure. Hey, how are you?
So, General Motors. If some of General Motors equity holders is a government,
No longer. Sold in December 2000.
theoretically. Now, the government doesn't want the same return on equity, in theory, than a classic investor.
You mean taxpayer? Governments have no money, so it's taxpayer money now. And
So, if they're just want
why
the money
not?
back,
You're now just an equity investor. The bailout's done. So if you're an equity investor in JP Morgan or in all these investments, it's really conventional equity, because it's
right, in GM they literally just want their money back, right? So they're almost like a zero coupon bond.
Well, if you're still holding on to equity, you want more than your money back, right? Because you took all the risks. So, but if you're willing to accept your money back, you want the cash back then as quickly as possible. So you should welcome not just a $5 billion buyback, you want a $50 billion buyback, right?
But not in terms of the buyback. I'm just wondering whether the fact that part of your shareholder base is the government.
I'll tell you where it's going to play
lowers
out.
the cost of capital.
No, it doesn't. It actually
It's
change.
almost like
It,
holding
it
debt.
might change your decision making because the government might say we want you to keep your factories in Michigan open because there's a social cost from you shutting those factories, which we now have to bear with unemployment. So so it'll show up in the investment decision part of the process, which you'll have a new factory in Michigan might have a negative net present value, but the government would say go ahead and take it anyway. Not because we have a lower cost of capital, but because whatever we pay to those unemployed workers will exceed. So in fact, if you're the government, here's how it works. You let the company keep its cost of capital. But in the big decisions where you have veto power, you'll take the net present value of the project, which will be a negative net present value. You'll compute what your cash outflows will be because those people will lose their jobs. And if that value is greater than the negative net present value, so because if you mess with the hurdle rate, you're actually not going to be able to do that, right? So you want to be explicit about why you want the company to do what you want to do, which is you want it to continue to invest in factories in Michigan because you think it'll create jobs and it'll reduce your costs elsewhere as a government. It'll create friction between you and the rest of the market because you're asking a company to do what taxpayers collectively should be doing. It's bad for the company, and I think it's bad for the economy because I think if you want to do that, it's better to let the company do the right thing and then come up with more, because it's not fair to ask GM stockholders to be the ones to bear the cost of keeping Michigan employment high.
If you have two classes of shares, let's say,
Right.
and one is a regular
No, which is
common
it's a
stock,
Petrobras example, right? That's
And
exactly
one